Hello everyone, this is module 7 of financial analysis for decision making. In this module, we are covering alternative approaches to making the optimal investment decision. And in this lecture, we will cover net present value analysis. Let's look at the agenda of this module first. First of all, we will cover net present value analysis. Then, internal rate of return analysis. And finally, we'll look at alternatives to discounted cash flow techniques. Whenever we analyze any project, we need to identify whether the project is independent or mutually exclusive. So when we evaluate projects, there might be more than one project at a time. So this is why it is important for us to identify is the project independent or mutually exclusive. Independent projects are projects in which acceptance of one project does not affect the acceptance of other projects. In this case, all acceptable projects will be accepted. If projects are mutually exclusive, in this case, acceptance of one project means we need to reject other project. Let's look at net present value. So we know that net present value means present value of cash inflows or simply benefit minus present value of project's cost. So the NPV of a project is simply the sum of all present values of estimated cash flows of the project minus project's present value of the project investment. And the discount rate which is used to find out net present value is normally the cost of capital of the project. Here is a formula to find out net present value over here. CF0 indicates initial investment, which is a negative cash flow. Then R indicates cost of capital or discount rate, and CFN indicates after-tax cash flow at period N. So how do we decide whether the project is accepted or rejected based on NPV? We know that NPV, if the NPV is greater than 0 or positive, we will accept the project because this project will add value to the shareholders. And if the NPV is less than 0 or negative, we will reject the project because if the NPV of project is negative, it will destroy the value of the shareholders. Here is a solved example of NPV. Here there are two projects, project S and L, and weighted average cost of capital for both projects are 10%, or this is the 10% is the discount rate. Let's look at the NPV calculation of project S. Project S has an initial in cost of 1000. Then it will generate 500 in year 1, $400 in year 2, $300 in year 3, and $100 in year 4. Based on the NPV formula, NPV of this project is $78.80, and NPV of project L is $100.40. So if projects are independent, we can accept both projects because NPV of both projects are positive. But if the projects are mutually exclusive, in that case we should accept project L because NPV of project L is more than NPV of project S. So therefore, in case of if the projects are mutually exclusive, we should accept project L because it will add more value to the shareholders. Now let's look at the reinvestment assumption of NPV. NPV method assumes that project's cash flows will be reinvested at R, or which is the cost of capital, or the opportunity cost of capital of the project. That's all about this lecture. In our next lecture, we'll cover internal rate of return analysis.